We now have a good introduction to accounting, as well as the people who use it on a regular basis. So let's switch gears a little bit here and talk about financial and management accounting. So, how do we distinguish between the two? Well, there's three major elements which separate the two branches of accounting. First, starting with financial accounting, this process is concerned with an external focus. So you're reporting to parties outside of the organization, such as shareholders, creditors, governing bodies. And second, the reporting is generally done on things that have happened in the past. So how did we perform last quarter, or last month, or last year? So it's a past focus. And finally, because of these two things, because you're focused on the past and also you're reporting to external parties as a general rule, we have a very strict and specific set of rules that we follow when doing financial accounting. So stuff like GAAP, which stands for Generally Accepted Accounting Principles. It used to be the old reporting system in Canada. And then we have a very commonly used system now called ASPE, Accounting Standards for Private Enterprises, or we have IFRS, which you're most likely to have heard of because it's used by publicly traded companies all over the world now, International Financial Reporting Standard. So looking at management accounting, it has an internal focus. So the idea is to exchange information within the organization, usually up to managers who use that information to make better decisions going forward. So that brings us to the second point, where management accounting has more of a future emphasis. You're using past information a lot of times and trying to figure out how you would be best served going forward. And last but not least, we have increased customizability in management accounting. So because there is not a strict set of rules and whole watchdog process, which we'll talk about, you are free to customize your accounting practices and more specifically reports in a way that best fit your needs. So which issue would a manager best like to address? So that gives you some free will around what a manager would like to focus on. Moving into ethics and why they matter in the accounting world. So in Canada, you will come across four different accounting designations. Chartered accountants, which is the oldest designation in the world. Certified general accountant, certified management accountant, and chartered professional accountant. So CPA, or chartered professional accountant, is the newest type of accountant in Canada. And the other three are no longer options for people to obtain. So everything has kind of been merged into one designation, but people with older designations still report what they had previously to the CPA merger. For example, I went to the CGA program, so I now self-report myself as a CPA, CGA. So looking more broadly at ethics, they're critical for an economy's operational efficiency. So there's a confidence and trust factor for a company's customers, employees, and suppliers. So to expand on that idea a little bit, if you were to shop with a company and you felt that you received an inadequate product and they refused to repair it or replace it for you, you wouldn't feel very good. And it would be highly unlikely you would go shop with that company again. Furthermore, you would probably not recommend them to any of your friends or family. In fact, you would probably say, please don't shop there. They don't take very good care of their customers. So that's an example of consumer confidence or trust being shattered because of a bad shopping experience. Imagine if you were an employee for the same company and they hired you for a couple weeks and they said after 2 weeks, well, we don't really want you around. You're not what we wanted, and by the way, we're not going to pay you. So that again, that's very unethical, and it's also highly harmful to someone's trust. They would likely take legal action against the company, and they would likely not recommend it as a good workplace for anybody else. And finally, to touch on suppliers, a lot of times businesses have arrangement with their suppliers where they order things for a while, maybe for a whole month, and at the end they pay one big bill. So if something were to happen where the bill wouldn't get paid, the supplier would no longer want to do business with that company. So very important to maintain confidence and trust, you must act ethically. Looking a little more closely at accountants specifically, there are three major elements which relate to ethics in the accounting world, and accountants are expected to maintain those ethical components in their daily life and workplace. Starting with confidentiality. This refers to not disclosing things which you're expected to keep to yourself. Accountants regularly deal with sensitive information, which can often be non-public information, and in theory, people should not be able to use that information until it becomes public for everybody's use. So if someone were to get hands on sensitive information, which nobody else knows, they would then be able to take advantage of that information for financial gain or some other gain. So, for example, if I am an accountant and I'm working on an audit and I disclose to my friends and family that the company is not doing well, they might sell their shares before the information is made public, and they would save themselves from losing a lot of money. It is, of course, illegal. It's also unethical. Moving on to integrity. This concept refers to having your loyalties lie where they should. So say you're having a conversation with a competing company and they say, hey, we're working on similar products here. We're all friends. So why don't you kind of lay off or delay what you're working on for just a little while, and We'll release our product first, and in return for your compliance, we'll make you a nice job offer for twice your salary after this all blows over. Well, you might be tempted to go ahead with that arrangement, but that would be a conflict of interest where you're not acting in the best interests of your employer. Another concept relating to integrity is the appearance of conflict of interest. You might not necessarily do anything wrong in your mind, like say the same company approaches you and they say, we're all going down to Florida for a nice golfing trip. We're going to have spa, we're going to have a nice hotel, and why don't you come down with us? Well, you might not be doing anything illegal or even unethical in your mind, but for somebody else, like your employer, this might seem like a conflict of interest. So you want to avoid those situations whenever possible. The last major ethical concept relating to accountants is objectivity. And objectivity involves looking at the full picture of something. So let's say I know my employer is a little bit of a hothead and I'm working on some financials for the company, and he comes by and asks me how things looking. I say, great news, boss. Our expenses are down 10%. So the boss walks away happy. He says, I'm going to give you a raise. Thank you for your great work. Well, what I didn't tell him was that revenues were actually down 20%. So income was down 10%. So if I had told him all that, I might have been out of a job, or at least missed out on the privilege of dealing with such an enthusiastic boss. So to wrap up here in the ethics section as it relates to accountants, we have corporate governance. This is a system by which shareholders control and direct major decision makers inside a firm. So an example might be stock bonuses. A portion of the compensation received by executives is either stock options or company shares that align their goal of creating individual wealth with the shareholders. So when the stock price goes up, everybody wins. So that kind of keeps the executives in line with what the shareholders want, which is a higher stock price, which is created by higher profits. Moving on to corporate social responsibility. This is considering all stakeholders in the decision-making process. In other words, doing the right thing. So going back to the other example, let's say the executives of that company with the stock options, they decide that we're going to start producing our goods outside as well as inside. So production goes up, sales go up, net profits go up, the shareholders are happy. But what about the neighbors around the factory? All of a sudden they have to deal with a whole lot of noise and air pollution. They aren't so happy. What should have happened is the company's executive should have also considered their neighbors, the residents of the area, as part of the decision-making process. Okay, so this video is running a little bit long, so I'm going to stop here. See you in the next clip.